Gold Bar Bot is an AI-powered model designed for the real-time analysis of the gold, silver, and gold miners markets. Its greatest strength is identifying timely exit points before the peak of an asset bubble, thus avoiding catastrophic losses like many traders experienced in January 2026, while preserving the tremendous gains made during bull markets. Gold Bar Bot also identifies and qualifies buy opportunities for adding to the core positions of buy and hold investors, or exit strategies for shorter-term and leveraged traders. Here is the latest update from goldbarbot.com for August 24th, 2026. Let's look at the latest gold technical risk chart. Gold's risk profile deteriorated modestly despite today's relatively small 0.36% advance because it came on top of an extraordinary multi-session run. COMEX Gold has now gained $274.80 in 4 sessions, or 6.29%. It is up 14.61% month to date and 37.55% from its 52-week low. That raises correction risk from 89 to 91. Overvaluation rises 78 to 80 and crash 72 to 75, while buy opportunity slips 38 to 35. However, the market is not displaying the full configuration associated with historical terminal peaks. Gold remains 12.74% below its January record of $5,318.40. Fundamentals also continue to provide genuine support rather than purely speculative momentum. Reuters reports gold reached a 3-month high Monday amid lower yields, a weaker dollar, treasury buybacks, and strong ETF demand. Gold core strategy: hold, no addition. Now let's look at the updated silver technical risk chart. Silver provided today's useful divergence. COMEX silver fell 1.33% to $68.54.1, ending its 3-day winning streak. It remains about 40.44% below its January $115.08 record, despite being 77.65% above its 52-week low. The pullback allows silver correction risk to decline, 88 to 86, overvaluation 78 to 77, crash 72 to 70, buy opportunity improves 41 to 44. This is exactly what we want to see after a rapid advance, some excess being absorbed without structural deterioration. But buy 44 remains well below our first core add threshold of 61. Silver core strategy: hold/wait/do not chase. If we look at the latest technical risk chart for the gold miners, GDX remains the most stretched member of the complex. GDX closed Monday at $103.54, another 0.69% advance, after Friday's close around $102.83. Its intraday range was $101.53 to $104.66. More importantly, GDX has risen about 13.4% since August 17th and roughly 38.5% in 1 month. That degree of minor acceleration warrants correction 92, overvaluation 82, crash 78, buy 32. GDX therefore remains our principal warning indicator. But even GDX crash 78 is still materially below the extreme sell region. GDX core: hold/no new money. Finally, we'll look at the combined precious metals risk index, which is the weighted combination of the gold, silver, and GDX risk indexes. Correction 89, overvaluation 79, crash 74. This is a high caution but not sell configuration. The model is saying that the probability of a normal correction is very high, valuation is stretched, and downside vulnerability has increased. But the evidence for a major collapse is not yet sufficient. That distinction is especially important for the taxable core. Under the established tax hurdle framework, we do not sacrifice long-term compounding merely to avoid an ordinary correction. A core trim requires an extreme sell configuration sufficiently severe that the expected drawdown avoided plausibly exceeds the tax cost. The strongest supportive factor is continued demand for gold as a fiscal monetary hedge. Reuters reports Monday's rally followed Treasury's expanded bond buyback announcement, declining yields and dollar weakness. while gold-backed ETFs attracted 46.7 metric tons worth roughly $6.4 billion, their largest inflow in 10 months. Rates remain the primary macro vulnerability. The 10-year Treasury yield fell about 2.8 basis points Monday to 4.709%, while the 30-year declined to about 5.249%. A reversal upward following inflation data or Jackson Hole would challenge the metals rally. The most constructive internal development today was silver's decline while gold and miners held firm. It reduces silver's short-term excess rather than creating a new synchronized speculative surge. The principal warning remains miners. GDX's approximately 38.5% one-month rise is considerably more aggressive than bullion and keeps GDX closest to a potential extreme sell progression. The market remains vulnerable to a normal correction, but this is still not an extreme sell signal. The tax hurdle, therefore, favors retaining the core and waiting for either a genuine extreme risk configuration or a correction that pushes combined buy through 61. That concludes our latest video update for the precious metals market. For a deeper dive, check out our other free charts and AI analysis at goldbarbot.com. In addition to tracking risk, we also assess buy opportunities for gold, silver, and the miners. Backtesting our AI model produced a warning to begin scaling out of metals on January 9, 2026, with a strong warning to sell all positions by January 23rd, a full week before the historic crash event on January 30th. Could you have benefited from that advice? If so, check out goldbarbot.com. New updates are posted several times per week. From all of us at goldbarbot.com, we wish you good luck and good fortune investing in precious metals.